Thank you very much, Grant, and good morning, ladies and gentlemen. So the aim of my presentation today is to examine the extent to which industry cost curves can help us determine how far prices can fall in a downturn. One of the main effects of weak demand for commodities this year, which Grant has just been discussing, has been its impact on price and producer margins. Commodity prices have continued to fall this year, and for many markets, the decline has been severe. In view of this, it's worth considering how far prices can decline from here and the extent to which the costs of production will offer price support. In order to conduct this analysis, it's customary to turn to short-run marginal costs, often defined by the 90th percentile of the cost curve. But just how helpful is the 90th percentile, or indeed the 75th or 50th percentiles, in informing us about the likely floor for prices? First, then, I'd just like to examine how far prices have fallen this year in relation to industry costs. I've chosen two extremes, the situation for met coal and that for copper. As illustrated, the price of met coal slumped to the 40th percentile of the cost curve in February of this year, leaving many producers struggling to remain in the market and a large proportion making financial losses. Those that are in operation today have lowered their costs, mainly out of sheer necessity. The situation in the copper market, however, is less critical. The average LME copper price for September indicates that the 3-month quotation has only fallen as far as the 88th percentile, suggesting that it's only producers at the top of the cost curve that are really under pressure. Other markets, such as aluminium, nickel, lead, and zinc, are somewhere in the middle of these two extremes. So in conclusion, all markets are currently suffering, but it's clear that some markets are in greater distress than others. Once prices fall, the initial response from producers is to protect margins by cutting costs. The extent to which this can be achieved is important, as it can prolong any potential decision to close. So how are sufficient cuts to production costs actually achieved? The answer is twofold: by reducing both controllable and non-controllable costs. In other words, it's often not just through squeezing excess fat out of the system that adequate reductions can be realized. Non-controllable cost reductions, such as falling input prices or depreciating currencies, are also critical in ensuring the survival of some mines. Taking the example of the met coal market, shown on the left-hand side of this slide, we estimate that the depreciation of commodity currencies has led to a 10% reduction in average costs this year compared with 2014, while declining oil prices have been responsible for a further 2% fall. In addition, the closure of high-cost mines has also lowered average industry costs. On top of these reductions, met coal miners have been aggressively lowering unit costs at the site level. Sustaining capital and maintenance expenditure is being avoided where possible. Contracts are being renegotiated, staff cuts are being made, and productivity drives implemented. We estimate that efficiency gains have lowered industry average costs by around 5%, taking the total cost reduction between 2014 and 2015 to close to 20%. On the right-hand side of this chart, at the other end of the spectrum, we show the extent to which the copper industry has experienced a reduction in costs to date. It should be noted that these costs represent actual costs as reported by a selection of the major copper producers. And so far, there's been a limited reduction in cash costs after byproduct credits, amounting to around 6% if we compare the first half of this year with the first half of 2014. The reduction in costs before byproduct credits has been more pronounced, but of course these reductions have been offset to some extent by falling byproduct revenues. We believe that much of the reduction in costs of producing copper to date has been the result of non-controllable factors such as depreciating currencies and lower energy costs, suggesting there is still more to do in terms of efficiency improvements and productivity gains. So in our view, costs for base metal producers still have further to fall. Two important uncontrollable factors driving costs lower in the current cycle have been currencies and oil prices. The key question is, will these trends be reversed in the coming years, or will they be maintained, thereby potentially leading to a sustained reduction in costs and a lower floor for metals prices? On the left-hand side of this chart, we've taken the example of copper and have produced an index of the US dollar against the major copper-producing currencies, each of which has been weighted according to its volume of copper production. Over the last 15 years, the US dollar has appreciated solidly against the major copper currencies for a number of reasons outlined in this chart. The latest period of dollar appreciation against the major copper currencies, however, has been more dramatic than previous periods and has been a key factor behind the reduction in site costs for copper miners over the last year. While we anticipate a reversal of this trend over the medium term, as you can see from the light blue line on the left-hand side of this slide, the decline will be modest in relation to the recent appreciation and will therefore have a minimal impact in lifting costs from current levels. A similar conclusion can be drawn from our forecast of oil prices, which are also unlikely to recover greatly in our outlook period. From lows of $50 to $60 per barrel in real terms, we're forecasting an increase to around $70 per barrel by the end of the decade. In conclusion, the cost reductions achieved as a result of weaker commodity currencies against the dollar and lower oil prices are unlikely to be fully reversed anytime soon. And of course, this doesn't just apply to the copper market, it's also valid for other metals to a greater or lesser extent. Having considered some of the important uncontrollable costs, I now want to move on and examine producer decisions regarding supply cuts and closures, which can prove critical to the depth and duration of any downturn. In any recession, if prices are to stop falling, we need to see an adequate reduction in supply. To date, the supply response has varied across different markets, both in terms of its speed and the size of the production cuts that have been implemented. In copper, for example, once prices cut into the top part of the cost curve, production cuts were reasonably swift to begin. Whereas in the bulk markets, especially met coal, the price had to stay low for much longer before a response was forthcoming. The important point is that a miner's position on the cost curve is not the only factor driving any decision to cut output or shut down. There are many others, some of which are identified here in this chart. The strength of a company's balance sheet, for example, is obviously an important consideration. Those miners with a strong balance sheet will be able to hold out for longer as they have greater cash reserves to pull on when times get tough. Indeed, Glencore's recent cutback announcements in copper and zinc are at least partly related to the company's efforts to sustain its balance sheet. The extent to which a company has hedged its sales and the proportion that it has sold on long-term contract will also influence any closure decision, as it will afford some protection against falling prices, at least in the short term. This can often explain the lagged response of some companies to a decline in price. Government protection is often cited as a factor behind the unresponsiveness of Chinese producers to low prices, particularly the large Chinese state-owned enterprises, where the existence of government subsidies and protection have long been identified. And finally, closure costs will also affect a company's decision to shut down. If these costs are prohibitively high, then it may pay to keep operating and hope for higher prices in a not-too-distant future. All of these factors will affect the speed with which an industry responds to low prices, cuts output, and returns the market to balance. Slow-responding markets will ultimately see lower prices for longer periods of time than those that take action quickly. So let's take a look at the long-run relationship between mine costs and prices. And for this analysis, I've used zinc as the example. So let's take a look at, so as you can see, there is a strong positive correlation between movements in costs and those for prices, implying that as prices turn down and cut into the cost curve at the 90th percentile, a supply response will take place, allowing the market to return to equilibrium and reversing the downward trend in price. But as we've just seen, costs are not static. They move lower depending on the extent to which input prices decline and the degree to which producers respond to the downturn in the form of efficiency improvements, production cuts, and shutdowns. This highlights the need for extreme caution in interpreting cost curves. The key point is, while the industry is actually in a downturn, we don't know in advance where the floor for costs is likely to settle. Any cost curve estimated before a downturn is very unlikely to look the same as one estimated afterwards, once we have full information regarding the industry's response. Crucially, once a downturn begins, it's vital to reforecast one's industry cost curves, taking into account the new environment for both cost inputs and the likely behavior of producers. Before concluding, it's worth spending a few moments just considering the outlook for costs and the extent to which the cost reductions that have taken place will, in our view, be sustained in the coming years. To do this, I've simply compared our forecast of costs in 2020 with its most recent peak, be that in 2011 or 2012 or 2013. The larger the bar on the chart, the greater the percentage reduction in costs from the peak. For the bulks, we believe that much of the cost-cutting seen to date will be sustained over the next 5 years, with average industry costs remaining some 30 to 40% below peak levels by 2020. To some extent, this reflects the changing structure of the industry, with the elimination of some higher-cost operations and the start-up of new, lower-cost mines. It also reflects the fact that there continue to be abundant resources of good quality ore in these markets. But these are not the only reasons. In both iron ore and met coal, we believe that most of the controllable cost reductions will be fully sustained, and here headcount is very important. The reorganization that has taken place at many companies producing bulk commodities will not be reversed, and staff requirements are therefore unlikely to increase back to pre-2014 levels in the coming years. Another area that has been severely cut is contractor services, which again are unlikely to return to former highs. Of course, the degree to which labour costs can be cut is partly dependent on the country in question and the strength of organised labour. By contrast, the outlook for base metals is rather different. In our view, the decline in costs taking place in base metals will be less severe and will also not be as sustainable in the medium term. In the copper market, factors such as the decline in ore grades, the need to develop deeper, more complex mines, the scarcity of important inputs such as water, electricity, and transport in important producing regions suggests that there continues to be long-term upward pressure on costs. In the zinc market too, cost reductions are unlikely to be sustained. Insufficient exploration in recent years has meant that there is a lack of large, low-cost greenfield projects to be developed in this market, implying that there continues to be a need for higher-cost mines. As a result, we're forecasting that by the end of the decade, in contrast to the bulks, base metal costs will remain just 5 to 10% below recent peak levels. The key point here, as my colleague Colin will discuss shortly, is the importance of discriminating between the commodities. As we have seen, all markets are currently under pressure, some significantly more than others. But our key conclusion is that the 90th percentile, or even the 75th or the 50th of an existing cost curve constructed before a downturn, is not a good guide to the floor for prices, as it too will move lower in a recession. If anything, the 90th percentile can be seen as analogous to a rear-view mirror in a car. While we all need to look back and see where the 90th percentile eventually settled, it cannot be used as a guide to what is about to take place in these markets in the future. Thank you very much for your attention, and now I'd like to hand over to my colleague, Colin.